21st October 2024, Goldman Sachs dropped the bombshell, forecasting just a 3% S&P 500 annual return the next 10 years. Could this mark the end of the high growth era? And what does this mean for you? In this video, we will explore the reasons behind Goldman Sachs' bold claims and share my thoughts on whether should we truly expect these low returns, along with my investment strategy moving forward. Before we dive into today's topic, you might be wondering, why should you listen to me? I spent the last 4 years as a portfolio manager helping ultra-wealthy clients navigate the ups and downs of the market. I've seen firsthand how shifts in the economy can impact investments. So today, I'm here to share what I've learned to help you make sense of Goldman Sachs' forecast and what it means for your money. Now, let's hear what Goldman Sachs' chief US equity strategist has to say about this forecast.
Well, there are two issues. The first is valuation. We know when the market trades at a high multiple, a high valuation, that the next 10 years is typically low relative to an environment where, say, the multiple is low at the beginning. You tend to get a pretty strong return in the subsequent decade.
Basically, he is saying that the current valuation is too high. To make sense of this, I've prepared a chart comparing historical net profit margins with the PE ratio. Notice how net profit margins have surged over time. Ignoring the COVID period of 2020, from 2017 to 2019, the average net profit margin was 11% with a PE of 22.5. Fast forward to 2021 to 2024, margins rose to 12.1% with a PE of 24.4. When companies earn more, shouldn't their valuation increase too? That's just normal, isn't it? As long as these valuations are backed by solid fundamentals rather than just hype, I will say there isn't much of an issue. Now, let's continue to hear the second reason.
And what's new about the analysis is that we also include a variable for concentration. We're in one of the highest concentration markets in 100 years.
Well, it's true that being heavily concentrated in one sector can come with some risks. The S&P 500 does a good job of balancing things out. Tech makes up only 31.7% of the index, with the rest spread across different sectors like financials, healthcare, and consumer discretionary to cushion against volatility. Plus, it's crucial to recognize that technology is the key to innovation and efficiency in every industry. Just take a look at the Vanguard Information Technology ETF, ticker VGT. Though it's concentrated solely on the infotech sector, it continues to perform well over the past decade, delivering an impressive 20.69% annually. The point I'm trying to make is that, while the S&P 500 index does have a high concentration in tech, it still has a good balance across other sectors to ensure both stability and growth. So, with all this in mind, should you really buy into the Goldman Sachs claim that the S&P 500 returns will drop to just 3%? The short answer is no. No one can predict the future with certainty, and Goldman Sachs has a notorious track record of misjudging the S&P 500 performance. Back in 2020, they estimated by end 2021, S&P 500 would close at 4,300, but it skyrocketed to 4,766. Then in 2021, they projected 4,900 for 2022, but the market dropped to 3,839. In 2022, their forecast for 2023 was between 3,700 and 4,000, yet it closed at 4,769. And in 2023, they forecasted 2024 to close at 4,700, but it's now already sitting at 5,808. So what does this tell you about market predictions? No one can predict the future accurately. So how should we approach investing when even the experts can't see the future? If you've been following this channel, you know I'm a huge fan of the S&P 500 index. It's been through the ups and downs of the market and still holds strong. If you are curious how the S&P 500 performed through the past downturns and came out ahead, I've got a deep dive on that in another video linked below. You don't want to miss it. For me personally, over the next decade, I will continue to invest in the S&P 500 index using a simple strategy. Market goes up, you buy. Market goes down, cry a bit, then buy more. And over the long term, you will do well. The key to successful investing is consistency. However, if Goldman's outlook has you feeling uneasy, you could balance things out with Invesco Equal-Weighted S&P 500 ETF, ticker RSP, which has delivered a solid 13.34% return year to date. You get less concentrated risk while still tapping into the S&P 500's potential. So, there you have it. Don't let fear dictate your investment strategy. Goldman Sachs predictions are just that, predictions. The market is inherently unpredictable, and history shows that the S&P 500 often defies expectations. Keep investing, stay diversified, and you will be well equipped to ride out any market storms. So, what's your take on Goldman Sachs prediction? Drop your thoughts in the comments below. If you found this video helpful, be sure to give it a thumbs up and smash the subscribe button for more insightful content. Thanks for watching and see you in the next video.